Well, hello then, folks, and it is Friday, the 28th of July, and we are at the end of another week of trading. Pretty action packed week on the economic calendar, especially with three of the four major central banks out this week. We kicked it off with the Fed, 7 o'clock on Wednesday, 1:15 yesterday being Thursday, the ECB, and then overnight this morning, the Bank of Japan. Now we'll break each of them down individually, but we'll start with the Fed. Well, there was a whole lot of nothing on Wednesday out of the Fed. I think the idea of this interest rate decision was actually to say nothing from Jerome Powell, which he managed to do quite well. There's no forward guidance, no ideas on where rates are heading going forward. Is this the end? Are we getting more rate hikes? No clear answer and no forward guidance provided. They are going to remain data dependent going forward, and that is what we are going to keep an eye on going forward. Is the incoming economic data, the first set of incoming economic data since they mentioned that on Wednesday were these GDP figures yesterday. 130, consensus 1.8%, actual 2.4, so a massive beat on expectations in the GDP figures. Durable goods orders, obviously it's a manufacturing figure, but consensus 1%, 4.7% was actual. So massively strong economic data yesterday out of the US, which caused some material downside in stocks yesterday, and big upside in the price of the US dollar. You can see here, obviously the ECB was a contributing factor to this move lower in the in euro dollar, but you can see euro dollar pushing lower aggressively. You can see the S&P 500 pushing lower aggressively. So clear negativity across stocks, clear positivity in terms of the US dollar, and the 10-year yield also went through the roof. So clearly markets paying attention to that economic data yesterday, which it was the first economic data, as I said, post-Fed. Do some more today, a little bit later on, core PCE, which we'll speak about in a minute. But data dependent going forward was the Fed's communication, and first round of economic data proved massively positive. So we'll see how that affects markets going forward. But the more positive data you get, the more likely of an interest rate hike. That then brings us on to the ECB yesterday, and where Christine Lagarde did open up the possibility to a pause in September. Now, a pause in September may not mean the end of interest rate hikes, but now a pause in September is different to what they have been suggesting previously. Had been suggesting previously that there was no end in sight in terms of interest rate hikes. Now there is potentially an interest or an end in sight in the in terms of hikes, which is probably a big week in my opinion in terms of the central banks. You got the Fed, you got the ECB, both preparing to stopping interest rates. Really, we're getting now a clear push towards it being definitively the end of interest rate hikes. We've not got a clear cut answer, but that is the way it is seemingly going at the moment. Now the ECB do have the economic data obviously themselves to think about, but German economic data have been dreadful this week. Started with the manufacturing PMI, massively negative data on Monday morning to kick things off. You come into the IFO business climate on Tuesday morning, again below consensus, below the previous figure. Consumer confidence figures negative in Germany. You got the GDP figures, which again, show a slowdown in the economy in terms of Q2 this year in relation to Q2 last year. GDP technically out of a recession, but 0% growth. So you've had two consecutive quarters of negative growth in Germany, but a print of 0%. So no expansion, no contraction. Does technically get them out of a recession, but definitely negative data in Europe's largest economy over the course of this week. Now we'll have to see next week how the Eurozone as a whole's figures start to come out. Obviously we'll digest that in next week's videos, but ECB again data dependent going forward, but Christine Lagarde did allude to a potential pause in September, and now there's no longer no end in sight. There is somewhat of an end in sight in terms of rate hikes from the ECB, which obviously has had a contributing factor to euro dollar downside, clear euro downside in yesterday's session. Now the German bond yields were a little bit. They were lower post release. Once you got the interest rate decision and the accompanying statement with then the press conference, they were slightly lower in the aftermath. But then that US data come in, US bonds or yields on US bonds went through the roof and then managed to drag German bond yields higher. But in today's session so far, you are seeing that downside step back in. You have to imagine that probably continues with now an end in sight, or certainly a pause in interest rate hikes potentially coming up. The DAX like it. The DAX reached fresh all-time highs yesterday and has continued to push higher and is holding up near the highs at the moment, managing to continue to trade up at the highs. That's probably a positive sign as we head into future sessions. It's probably a little bit of a difficult trade into the close today. Certainly has been a difficult trade over the course of this morning, but into next week, maybe some potential for some further upside in the DAX on the back of the ECB potentially going on a pause, especially if these yields continue lower, likely to be supportive for the German stock index. Onto the Bank of Japan this morning, where they have technically kind of ditched the upper band of their yield curve control. Now, there's not been a change to it. The target rate for the 10-year yield is still at 0%, but they now no longer see the 0.5% upper band as like a hard limit. They are happy for prices to trade above it. They're willing to purchase 10-year government. They're willing to purchase 10-year debt at 1% each day, kind of suggesting in effect a doubling of the the band in terms of the range of the yields. So they're happy to facilitate higher prices on yields. Happy for that to raise a little bit higher than what they were previously willing to accept. So that would suggest to me, if they went and go 0.5 and now we're going to raise it to 1, we're happy to accept 1%. That's effectively an interest rate hike. They wanted to avoid being seen to do that, and with willing to purchase debt at 1% each day, and are happy to allow the yield, the 10-year yield to raise above 0.5%. Effectively moves towards a more normalization. Hasn't ditched yield curve control, still employing it, but raising it slightly in order to make monetary policy, or their current monetary policy settings, more sustainable, is seen as a bit of a hawkish step from the Bank of Japan. Now, if yields are higher in Japan, maybe it potentially allows Japanese investors who are heavy investors in US bonds, heavy investors in German bonds, maybe allows them to move away from US and German bond yields bonds across the world, and back into Japanese, back to Japanese bonds. So if interest rates rise slightly in Japan, and then there's an increased demand for Japanese bonds, that's obviously a positive for the Japanese yen. Plus, if there's a contraction of the yield differentials between the Japanese 10-year yield and the rest of the world, that again is supportive for the Japanese yen. So to me, it kind of suggests that the Bank of Japan do not want the Japanese yen to move any lower than it has done. They don't seemingly want US dollar yen. They don't seemingly want dollar yen to be any higher than it currently is, and you'd have to imagine some downside in dollar yen to continue. But the difficulty with that is obviously the positive US data that has come out, and that's likely to cap losses on dollar yen. So probably a better option to trade against something else, maybe euro yen is a good short at the moment, something definitely worth keeping an eye on. But as that 10-year yield in Japan continues to rise, as it has done over the course of today's session, if that continues to rise and makes its way up towards 1%, which you have to imagine markets will probably want to test that out and see how high that wants to go. The longer that continues to push higher, the more supportive it is for the Japanese yen. And if that US data remains strong and markets begin to price in one more interest rate hike, maybe not the best to be short dollar yen, euro yen. Downside seems a decent bet in the coming trading sessions ahead. We do have core PCE, the Fed's preferred metric of inflation, out this afternoon. We have German inflation out this afternoon. A miss on German inflation should send euros lower. Maybe a decent trade lower euro yen off the back of that. Yeah, maybe 6% or even below 6%. That is kind of further reaffirms the stance that they may go on a pause in September, which, as I said, should be negative for the euro. Japanese yen seems a decent currency to pair that against. Core PCE. Now you've had, I mean, obviously from a kind of humanitarian perspective, you're not going to want inflation to continue to rise higher, but from a trading perspective of trying to make some cash, you've got the Fed saying on Wednesday data dependent going forward, right? You get the data yesterday, you get the durable goods orders, the GDP figures massively positive. If this core PCE prints above consensus, maybe even above previous, and gets up to 0.4, 0.5, just a surprise beat, that is a situation where stocks should push lower, US yield should push higher, the dollar should push higher, and that I think creates more opportunities than a slight miss. So that's what we'll be hoping for in terms of trying to make some cash later on. But apart from that, that is really where we are at for this week. Apart from just quickly mention the Chinese stock index continues to push higher. Further measures introduced overnight from China targeting the tech sector. They have targeted the real estate sector, they're targeting the tech sector, and they're introducing methods, continue to introduce measures in order to prop up the economy. Right, obviously the economy has struggled, not really generated the kind of growth and the kind of growth since their reopening from their COVID lockdown measures. So targeted stimulus measures at certain sectors of the economy continue, and that is seen as a positive for the Chinese stock index, and you'd have to imagine that probably continues higher, certainly in the short term, as these policy measures continue to be input into the economy. So raft of things out this week, a lot of information to go through, a lot of central banks. All in all, we are approaching the end of the hiking cycles. Whether we are at the end of the hiking cycles is not clear just yet, but we are very nearly there. We'll cross that bridge when it comes to it, when markets or when central banks keep rates steady. How markets react, we'll have to figure that out once it comes around to it. But certainly interest rates of 5.5, 5.75%, not the best for business conditions, but we'll see how that plays out in the coming trading sessions ahead. But that's it from me. We'll have another video out pre-US once we get those PCE figures out. But we'll update a little bit further this afternoon on that. But that is a wrap up of the week. Raft of Central Banks, hawkish Bank of Japan, dovish ECB, and a neutral Fed. That is the story of this week.